Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about AUTOZONE INC quarterly report. AUTOZONE Inc. offers a wide range of businesses and services, including retailing and distribution of automotive replacement parts and accessories, sales, program with commercial credit and delivery of parts, and other products online sales through AUTOZONE.com, DuralastParts.com, and ALLDATA.com automotive diagnostic, repair, collision, and shop management information software under the ALLDATA brand towing services tire repairs additionally. AUTOZONE provides a variety of maintenance and accessory products, including oil and fuel additives, brake drums, rotors, shoes, and pads, air fresheners, cell phone accessories, floor mats and seat covers, interior and exterior accessories, tools, vehicle entertainment systems, wash and wax products. The company also offers a range of automotive hard parts, maintenance items, and non-automotive products. The lack of significant change in AUTOZONE Inc.'s stock price over the past year can be attributed to several factors. The company's quarterly earnings reports, which are typically a key driver of stock price movements, have had minimal impact on the stock price. Despite fluctuations in net sales and EPS, none of these announcements caused a stock price swing exceeding 4.63%. The authorization of an additional $1.5 billion stock repurchase program by AUTOZONE's board of directors also failed to trigger a significant immediate stock price surge. Similarly, the company's annual meeting of stockholders did not result in any notable stock price fluctuations. These events collectively suggest that investors have been relatively unaffected by recent news and announcements from AUTOZONE Inc., resulting in minimal changes to the company's stock price over the past year. The primary drivers of revenue growth at AUTOZONE are multifaceted, contributing to an overall increase in net sales by 8.2%. Key factors include a significant rise in same-store sales, expansion of the commercial sales program, and substantial online sales through various platforms. Additionally, the company's acquisition of new domestic and international stores has generated additional revenue streams. Furthermore, growth in domestic commercial sales has also contributed to the overall increase in net sales. Net income and profit margins decline. A shift in financial performance. The financial performance of a company has undergone a significant shift between 2024 and 2025. Net income decreased by $33.11 million, 5.9%, from $564.93 million to $530.82 million, indicating a decline in profitability. This decrease is accompanied by a reduction in profit margins, with gross profit margin decreasing to 50.8% from 52.9%, and operating profit margin dropping to 17% from 19.7%. The increase in operating, selling, general and administrative expenses as a percentage of sales further contributes to the decline in profitability. The company's financial performance indicates a consistent generation of positive operating cash flow. The net cash provided by operating activities in 2025 was $944,171, while it was $811,803 in 2024. This trend confirms that the company has been able to generate sufficient cash from its core operations to support its growth and investments. The company's debt level and interest expenses have undergone some changes in recent years. In terms of debt, the long-term debt has decreased from $8,799,775 to $8,623,112, indicating a reduction in debt levels. However, total debt before discounts and debt issuance costs shows a slight decrease from $8,848,600 to $8,669,500 between August 2025 and November 2025. Regarding interest expenses, there has been a minor decrease of 1.2% from 2024 to 2025, with net interest expense decreasing by $1.3 million from $107.6 million to $106.3 million. Overall, while there have been some fluctuations in debt levels and interest expenses, the changes are relatively small and do not indicate a significant shift. The company's financial performance was marked by significant growth across various segments. Notably, domestic sales in the U.S. saw a substantial 14.5% increase, indicating strong demand for commercial products within the country. International markets also contributed to the overall growth, although specific metrics were not provided for Mexico and Brazil. Management is optimistic about the company's outlook, citing growth initiatives as a key focus area. They expect to increase investment in business for fiscal 2026, primarily directed towards these initiatives. The company plans to rely on internally generated funds for capital expenditures and working capital requirements, while leveraging extended payment terms with suppliers. Management acknowledges that market growth is tied to industry trends, but notes that macroeconomic factors are outside of their control. Overall, the company is positioning itself for growth and expansion. There were no significant transactions involving the acquisition of new businesses or assets by the company. Additionally, the company did not sell off any major divisions or subsidiaries through divestitures. This indicates a stable and unchanged business structure for the period in question. The company's financial summary reveals a clear trend of share repurchases. Over the past few years, the company has consistently engaged in buying back its own shares through various programs and initiatives. Specifically, it is noted that the company has repurchased a total of 155.7 million shares at an aggregate cost of $38.9 billion. Furthermore, specific amounts are mentioned for share buybacks in both 2025, $427.2 million, and 2024, $540.1 million. The presence of a stock repurchase program also confirms the company's intention to buy back its own shares. Additionally, it is stated that the company has bought back shares during the quarter ended November 22, 2025. These details collectively demonstrate that the company has indeed engaged in share buybacks rather than paying dividends. Concerns about inventory buildup and supply chain disruption exist. There are valid concerns regarding inventory buildup and supply chain disruption. While direct mentions of inventory buildup are absent, a high accounts payable to inventory ratio of 115.6% on November 22, 2025, suggests potential issues. Supply chain disruptions are also a concern. Supplier participation is optional, which could lead to inconsistent supply chains. Disruptions in the supply chain have been acknowledged, page 21, and tariffs driven by inflation are affecting the LIFO credit reserve balance, page 11. These factors collectively indicate that inventory buildup and supply chain disruption pose significant risks. That concludes the financial summary for AUTOZONE INC. Feel free to comment below, and I will be happy to answer them when possible.